Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Tom, welcome back to the show.
Thanks, Owen. Great to be here in the new year with you.
Yeah, we're recording here at Betashares HQ, Sydney. It's always a pleasure because we get these beautiful views of the water here. But today we're going to be talking about something that is on the tips of the tongue of a lot of investors who are writing into us and saying, hey, what can I do about blah? And that blah is, how can I get income in this market? So we're going to talk all about that. We're going to zoom in onto the Australian market. The local stock market has performed very well. And last year, Cameron, a colleague of yours, and I did an episode on passive income from ETFs. That was, I think it was like a top 2 or top 3 episode in terms of total downloads across our network. And that's important because we do 400 plus episodes a year across all of our shows. So I'm betting this one's going to be great. If you're interested in passive income, you're in the right place. And we've got Tom here to be our field guide. I'm going to ask you, though, to explain the context of that. So that was then, this is now. Why should we be talking about this right now?
Yeah, look, big shoes to fill from the episode last year, but I'll do my best. Look, income is always super topical in Australia, right? Like, Australian investors love income. I think it goes back to the franking credit system in part. Like, it's super beneficial when you get income from shares, you can have these tax benefits. So that's one thing. Also, our market has historically been one of the highest income producing. So it's always really topical. Why now more so than ever though? It's because those levels of income are dropping and have dropped quite significantly. So over the past 12 months, the broader Australian market had a distribution yield or dividend yield, of 3.6%. Now, Australian investors are used to that number being well north of 4%. The past 25 years, the average was 4.2%. So, those incomes are coming down. Investors are probably noticing that and they're worried. They're saying, hey, I've always got my income. It's been a really reliable source. What do I do now? Where can I look? And so it's probably a really important issue to dive into for Australian investors.
Yeah, because a lot of the time people look at the US stock market and they're like, that's the one that grows fast. It's got these tech companies. It's leading the world. But then they're like, but I do want some Australian shares because the income from Australian shares is what I get. And so it's kind of like you got the best of both worlds. But if the income's not there, at least it seems, people are like thinking, well, what am I actually doing here kind of thing. So just to not leave anyone behind, because we're going to use phrases like income, yield, dividends, distributions, can you define the term yield for folks that aren't familiar with it? But second of all, can then you tack onto that, like why ETFs and how ETFs make sense for people that are interested in this thing called yield?
Yeah, 100%. A really, really important starting point. So when we talk about yield, we're talking about really the income or the cash flow we're getting from our investments. So to use a super simple example, I just mentioned the past 12 months, the dividend yield on the Australian market was 3.6%. Mm-hmm. So if you had $100 invested in the Australian market, you would have expected to get $3.60, right? So it's your income you received divided by the investment you have in the market. So that's the 3.6 over 100. So that's super simple for investors. And it's not just from shares and stocks, right? You also can get coupons from bonds. You can get rental income from your property. These are also sources of yield, right? Same concept. Now, moving into the ETF landscape, ETFs are such a great tool for access to various different parts of the market and different solutions, and income is no outlier, right? There's a whole category of ETFs called equity income ETFs, which aim to solve that question for investors. Hey, I want to try and get more income out of the shares I'm holding or more income out of the market. Where can I look? Oh, great. There's these awesome solutions called equity income ETFs designed to generate higher income for investors.
I like it. And that is probably the big thing is ETFs now, instead of picking which stock might pay a dividend, you can just get a basket, Aussie shares as a whole, for example, with A200 or something like that. There is a difference, however, Tom, when people buy an ETF for income, say with a direct share, we call it a distribution, right? And ETFs also pay at kind of set dates almost, like it's like quarterly, like every 3 months, yearly, that sort of thing. But then there's some things like AAA, which is an ETF that we hold at Rask, and I hold, which is just a cash ETF. I'll let you explain what that does, but that one is monthly, right?
Yeah, exactly right. So for investors looking at this type of ETF, as per usual, like go to the fund page because it'll tell you all the information. Typically with equity income ETFs, you can typically expect them to pay quarterly, which is good because you're not getting these lumps or different timings from individual stocks. We're kind of building up all the dividends we receive over that quarter, then we pay them out to you as the investors. So that's good. And also, it's consistent. It's going to be the same period every time each year. But to your point, some fixed income ETFs. So then we're talking about things like bonds, things like cash ETFs. That AAA ETF you mentioned is just holding cash in bank accounts, right? But we can get, slightly better rates because we've got quite a bit of money in there. And we're like an institution as well. So with that one, we want that to mirror the experience that investors are used to with a bank account. So we said, hey, we'll pay that monthly interest payment. So a lot of fixed income ETFs, at least our fixed income ETFs, we aim to pay monthly because that's the experience investors are used to holding the underlying asset. Yeah.
I like it. So then you can blend them all together and that's how you build a portfolio that's focused on income. And you mentioned like at the top of the show that historically the yield that people would get on Australian shares was probably 4% plus franking credits, which was a really respectable income. Like maybe you're up over 5% with franking credits easily, right? So versus the US stock market, which historically, the numbers, but like 1 to 2% maybe, right?
Yeah.
And so now people are thinking, well, what do I do? I think, I don't know if it was you or Cameron that previously shared this chart in one of the blogs that you did on the Betashares website. And it kind of showed like, if you took all of the companies on the Australian share market and you got an ETF for that and you saw where their income come from, like which companies put the income into the ETF, so to speak, a lot of it came from like the usual names like BHP and CBA and that sort of stuff. But with those companies, in particular CBA, like rising, obviously that pushes down the yield.
Mm-hmm.
How do you think about the opportunity, but also the challenge there? Like how does the challenge of finding income translate into a strategy that people can use that are watching or listening right now?
Yeah, good question. Actually, that chart, I only updated it, a few weeks ago, actually. We're going to do another blog soon about this topic, right?
Right.
And you're right. So the top 10 names, the 10 largest contributors to the broader market's income account for 60% of the total income, right? So that adds a bit of fragility to our income, right? There's concentration there. If one of those 10 names, or all of those 10 names were to suffer, for particular reasons, could really impact the Australian income landscape. And that's kind of what we've seen happen. Because the second issue is, of those 10 names, pretty much all of them are either in the financials or in the materials sector, right? And to your point, banks have gone on a really good run last year, which was great for the capital growth of the Australian market. But the big banks' earnings didn't keep up. So their prices appreciated quite a lot. The earnings didn't keep up. So their dividends increased a bit, but nowhere near to the amount of their price. So that yield then has come down. Remember our equation from earlier? That's number one. And we even actually, despite the run in banks, we saw some cuts as well. ANZ and Macquarie both had cuts to dividends recently. So that's one side of it. The other side, we look at the materials and energy sectors, typically quite cyclical parts of the market. Right, they go through good times, they go through bad times. And recently it's been tougher. We've had, slowdown from China, we've had lower commodity prices, and that's really impacted the income from those companies. So, this concentrated source of income, and those companies and sectors are under pressure. So for investors, they have to think, how can we look beyond, the broader market? How can we look beyond those traditional sources to find sources of income? And, ETFs can play a large role in that.
Yeah, because I did a bit of analysis on this last year. I think it was maybe around that time when that blog was first brought up, because I was like, well, I think I could be wrong about the premise of that, but it was kind of like, if all the income comes from these 10 companies, not all of it, but like a lot of it, but commodities like iron ore for BHP and Rio and all that start to slow down and the banks aren't growing, well, what are we actually getting as end investors, right? Fortunately, CBA and all those kept on just rallying. But now people are asking the question, well, particularly our older listeners that are either financially independent, like as in early retirement, or just aiming for retirement, they're thinking, well, that's interesting now. So then is my income sustainable, kind of thing? You know what I'm saying? And so what do people look at? Like where do they go? How do you think about, maybe even more broadly, how do you think about things like resources? How do you think about banks? Like those are challenges, right?
Yeah, definitely. So if I think, I painted a bit of a picture there before. So with the banks, we're a little bit worried, right? Like a lot of people, they've done really well. As I mentioned, the earnings haven't kept up. So that means their valuations have increased quite a bit. So, at this starting point, at the start of 2025, not only has that yield come down from the good performance or the price increasing, we're probably at a point now where, those investors asking that question, well, at least with that capital growth, that's under threat now as well. CBA is the most expensive bank in the world by a mile, and the next closest is Macquarie. All of our big four, plus Macquarie, if you throw that one in as well, are in the top quartile globally for how expensive they are. So, valuations tend to be mean reverting. They tend to come back to a norm. So that worries us a bit. It worries us in terms of the outlook for the banks within Australia. Resource companies, as I mentioned, from our viewpoint, quite cyclical companies. There are potential signs that things could improve. Maybe if we get that global rate cutting cycle that was suspected to happen, that could be promoted for economic growth. We might see some more, growing within the US in particular, and that might help buoy commodities, but it's not a clear picture, right? It's not a clear picture. There's a lot going on globally this year. There's a lot of policy uncertainty. So, our outlook for those largest companies in Australia and the income they provided us is fairly negative at the moment. Yeah, it's a concern.
So this is, I didn't know you'd say that, obviously, but I kind of figured that might be a view that you have, because I share a similar sentiment, right? So one of the ETFs in your range that I've looked at is the X20 ETF, because you might want to still have some of those big companies, but maybe it's just not having as much. Which, I'll let you explain what the ETF generally does, but that's like one way to stay invested as far as I'm thinking, but also, diversify away a bit from those companies you might be a bit unsure about.
Yeah, exactly right. So that would come down to, if you had fears around that concentration in the market and the growth of those large companies going forward, X20 is a really neat ETF where you take the top 200 companies on the ASX and you just strip out the top 20. Right, so you hold numbers, 100, 21 to 100 to 200, which is a great way to upweight some of those mid caps, some of those smaller caps that they get fairly crowded out of our broader market, but they've had really good growth. A lot of them, some of them have really strong earnings growth as well, and they're also Australian companies. They understand how much we appreciate income. So actually, a lot of them pay really good income as well because they understand that the Australian investor appreciates that. So that's one really great, simple way, I guess, to help diversify the Australian portfolio without necessarily sacrificing too much income, particularly if you have fears of those larger names at the top end.
Yeah, because like those are companies, like to paint the picture for people, companies in that ETF would be companies like Reece, ARB, which makes the 4x4 accessories, like companies that you would just walk past in the street every day and you'd think, oh, that's a pretty cool company. Lavisa, like really interesting businesses that are growing and paying income. And I think that for people's context, so we're not saying, well, you exclude the top 20 like the banks and you just get these tiny little companies. They're actual really big businesses, sometimes global businesses, right?
Yeah, no, that's 100% right. Like it's a great way because of the broader market, as we know, as we're talking about, like it's just the nature of our market, but it's fairly concentrated in these older blue chip companies, which are great for a lot of reasons, but you are missing out on like those names you just listed there. Like people would interact with those day to day. and understand how good those businesses are. Things like Breville, for instance, awesome business. I've got some Breville appliances at home.
Yep.
And just their growth has been great. Their return in terms of dividends to investors has been great. So just, I guess, it's a big topic, not just within income, but just globally this year, just that diversification, diversify, away from, concentrated equity markets, diversify your streams of income. There's plenty of sources of passive income within the Australian equity market. You just need to look maybe beyond the broader index for the first time in a while.
Yeah. So it's not just income from shares and Aussie shares in particular that we can get. So we mentioned at the top of the show, different styles of ETFs, which I'm hoping to pick your brain about. So you can blend Australian shares. So like A200, a lot of people in our community own that ETF and dollar cost average into it. But you could blend that, say, we've already mentioned X20, but then there's other things. So can you talk us through some of the other ways to generate yield across people's portfolios, maybe outside of Aussie shares?
Yeah, definitely. One way, outside of Aussie shares, or still including Aussie shares, but I guess an additional source of income, we've got a suite of funds called the Yield Maximizer funds, and these are great ETFs. So we've got one for Australia, which is YMAX, but we've also got one for the S&P 500, which is UMAX, and the NASDAQ 100, which is QMAX. So each hold those respective markets, right? But what they do, they generate income from an additional source, and it's called a covered call strategy. Now, some of your sophisticated listeners might have heard of this before, but to put it in very simple terms, we hold the underlying basket of shares. So let's just use the Australia one for simplicity. We hold the top 20 companies in Australia. So we know historically those have been good dividend payers, but at the moment we've talked about this whole episode, they're under a bit of stress. So we want to try and get a bit more income, from that position. So what you can do is you can sell a call option, right? And what that means is the person who buys it off you, they give you some income. Okay, awesome. We've just generated a source of income from selling some call options on our shares. Now, there's no free lunch in investing. There has to be some give or payoff. And what that payoff is, if those companies perform really, really well, you are capping your upside, right? Because the person who paid you that money to buy the call option, they have the right to say, hey, wait a minute, those have done really well. I'm going to buy those off you for this price we agreed on. So hopefully that...
Yeah, it's like a contract.
Exactly right. But what that means is we've just added an additional source of income on top of the shares that are already paying us dividends. So that YMAX fund, for instance, that's paying closer to a 7.5% distribution yield over the past 12 months, right? And that's not including franking. So that's a really awesome pickup. And now, we've got it, as I mentioned, in the US as well. What's been quite incredible, we've got that strategy over the NASDAQ 100, right? The NASDAQ 100 has done really well. It's grown really strongly, but I just looked before I came on this episode, and our QMAX fund has returned this same amount over the past 12 months. The reason being because since the NASDAQ's a bit more volatile, we get more money from that person buying the call option, because more volatility means there's a bit of a higher price for it. So that's good. Number one, we're getting a bit more income, so that's helped out. Number two, with those returns that we've generated, similar to NASDAQ, we've taken about 5% as income rather than the normal NASDAQ's around 1%. So that's a good example of where you can go to a market with a pretty low income yield, still generate really good returns, but take more as income out of it rather than the capital appreciation.
And I find those strategies, I'm glad you brought them up, because it kind of like pushes our community to think a bit more about how to use these other ETFs, which they might be kind of toying with already. But I find that those strategies in particular work really well when people expect, like we have laid out, the whole probably not going to grow that fast top 20. But also if you think that markets are not necessarily going to shoot the lights out. So you kind of got what we would call in finance a sideways market. It's kind of like saying, well, the market did really well last year. Now the income yield's a bit lower. Maybe I can use this strategy for now. And then in years 2 or 3 or 4, maybe I'll switch back to the original one. But for now, I'll use that. That's a really good way to think about it. What about things like complementing that with like bonds or cash or those types of things? Are you thinking about that right now?
Yeah, definitely. So at the moment, if we look at where bond yields are, so how much bonds are paying us income, right? Government bond yields, they're the highest they've been in over a decade. So that means bonds are offering investors, attractive income. And it also means another thing. So investors who have heard of bonds before or thought about how those work in portfolios might have heard about their defensive attributes, right? They tend to, be good diversifiers for equities because, when equities sell off due to, problems in the economy or et cetera, typically that means bonds should do well. And these, higher levels of yields we have, what that essentially means is if we do get one of those scenarios where equities sell off because of the economy, bonds are really well placed to play that traditional role. Unlike what we saw in 2022. I won't go into detail on that, but in 2022, it was a sell-off due to interest rates increasing. So it's a bit of a different dynamic there.
Yeah,
exactly right. Bonds are really well placed at the moment to provide strong income in portfolios. If you think about it, we just said the past 12 months, the Australian market was giving us 3.6%. Well, the yield on a 10-year Australian government bond, so the safest type of bond, is giving you about 4.5%. So there's already an instant pickup there. And then you can go even a step further. So we've got CRED, which is one of our ETFs. That's got Australian corporate bonds in it. So you get even a bit more income for the risk you're taking on holding a corporation's bonds versus a government bonds. So you can start getting really, really compelling income from bonds for the first time in a while, which is really exciting.
Yeah, because that's actually interesting. You mentioned that. I've written that down. CRED is CRED for people that want the ticker symbol. Because now people can realize, historically, I've known Australian shares pay income, but it doesn't have to just be a index strategy, right? It doesn't have to be just the same old vanilla ice cream that people eat. There's the YMAX, which can complement the yield from the Aussie shares. But then there's other asset classes. And this is the beauty of investing once you get a bit more sophisticated and you start to think, well, I'm going to be investing for 5-10 years, but I want to smooth the journey. I don't just want all tech stocks or all Bitcoin, some people, or whatever. And you can see how you can stay invested, but, be also mindful that, markets might be a bit shaky. And I think that's the next step for people. Because I'm just thinking off the top of my head here, Tom, if people combined A200, X20, CRED, YMAX, they're on their way to getting a really good portfolio straight out of the gate, right?
Yeah.
And sure, there's the diversified ETFs from Betashares that do a lot of that for you. You can do it in the Betashares Direct app as well. You can go to the portfolios as well. How about then when it comes to things like the question that I'm always getting? I've got a couple more questions for you, but this one here is probably the most important as we look out over the year. I've written it down is, what would you say to people who are currently fearful of investing? So this is not just people who are newer to investing, Tom. It's not just people that are in their first 3 to 4 years. I'm speaking to a lot of people that have been doing it for 10 or 15 years, catching up with them in investor calls, and they're saying I'm worried. I'm transitioning to retirement. I've been doing this for 7 years, but I'm just worried. What do you say?
Yeah, of course. I mean, it's so natural. It's so natural. There's, a lot of investor biases out there that almost hinder our ability to invest in the best way. And a lot of it comes down to fear. Markets have done really well. People are worried that there's an imminent sell-off coming. I'd say a few things. Firstly, and the most important thing is, remember your investment goals. Why are you investing? What are you investing for? And that can really dictate your time frame, your tolerance for risk. Secondly, set an investment plan and stick to it, right? Things like dollar cost averaging into the market or dollar cost averaging into, as you mentioned, a diverse range of different ETFs. That's an awesome way to diversify your risk, not just your entry point risk, but you're diversifying across the things you're investing into. And then also for those clients, the ones who are transitioning from, you mentioned they've been in the market a while, they're becoming retirees, revisit your asset allocation. Maybe you've built this awesome capital base over the past 20 years in technology stocks, which is great. Now, if you're transitioning into that retirement phase, maybe, hey, look at this awesome capital base. I could shift that into things that are a bit safer, if I can use the word safer, perceived, that pay higher income. Now, this awesome capital base is going to work for you, generating you income, which is really good. And then just in terms of just in general for people to put them at comfort, last year, if you looked at the investment bank outlook, so I read a lot of the investment bank outlooks at the start of the year, not a single one of them got even close to where the S&P 500 ended, right? So I sit there and I'm the same. I go, I'm worried maybe I won't put my DCA in this month, or I'm smarter than the market, I can time it. Even the most sophisticated investment bank researchers in the world can't get it right. So, you're better off sticking to it, but being smart about it, setting a good level of growth in defensive assets, knowing what you're invested in, listening to people like yourself, Owen, and educating yourself. But once you've done that, just try and stick to your plan, because the number one thing is you skip your plan, you realize that's what's cost you, not the markets, not anything else.
Yeah. I actually remember, so one of my favorite studies out of the US was a study by Charles Schwab, which was a question, it asked the question, does market timing work? But then I realized you guys in the investment strategy team took the premise of that and applied it to the Australian market. Does that work? And you showed different examples of like, if you timed it perfectly, if you had the worst timing, if you had $100 a month, if you had $2,000 at the start of the year, whatever it was, like you showed all these different variants of that. And again, it showed the same thing, which is that consistent investing, even if the market's up or down, still works. And I think that's the message I want to hit home. Like I was chatting to, you mentioned like guys and gals doing really well out of tech stocks and whatever, and revisiting asset allocation. A lot of Aussies have done really well out of property. And they're now sitting there going, land tax, interest rates, all this government pressure for me to sell my investment property. And they're sitting there like with headaches, they're stressing. And I think to myself as an objective person looking in, I think, yeah, but you can go and get all this yield over here and you don't even have to deal with one tenant ever. And you can feel good about having your money because you're just going to get paid a check, from Betashares, for example, into your brokerage account, done. And I think that is what people from this episode will take is there are so many options within the ETF world right now, just to go and get started and to start generating true passive income. Last question for you, Tom, which is, I asked you this last year, and I think that was an episode where we talked about the NASDAQ 100 and a bunch of other stuff. And it was really impressive. But this year I wanted to ask you, if you could leave our listeners and viewers with one ETF, it doesn't have to be an ETF, it could be a theme, could be even just a resource like, hey, go and check this out for this year because I thought it was great. Looking ahead in 2025 and beyond, what would it be?
Yeah, so you actually gave a nod to this earlier, but I mean, a big part of the success of ETFs, right, has been, they've really democratized investing. They've given access to the average punter to jump in the market and access awesome strategies, access the index for low cost. And that's like really helped take away some frictions from investing. And something I want to give a shout out to a lot of the work that the team that Betashares here has done is the Betashares Direct platform.
Yep.
Because what we're trying to do with that is take the next step in terms of, we offer free brokerage on that platform for all Australian ETFs, not just Betashares and also Australian shares. And it's like another barrier being taken down. If you think about dollar cost averaging on platforms historically, you'd have to pay, I don't know, $9, $10 brokerage. That is a hindrance. That's a friction in investing. So I think, those costs are becoming commoditized and they will be free in the future. And, really excited that Betashares is at the forefront of that. So I'd encourage, your investors who've adopted ETFs for all those great reasons to, maybe take the next step and, take a look at something like Betashares Direct, learn about how that can benefit their investing journey as well.
Yeah, cool. Like it, mate. Well, I'm going to put a link in the show notes to all of the ETFs that we mentioned, but in particular, I'm going to call out X20. I think that's a really good learning curve for people. If you're past just investing in the vanilla one, A200, go and check out something like X20. YMAX is probably the next level up. But then if you want to step across and learn about something new, I'd say CRED, which you mentioned. That's an ETF that I've been looking at a lot lately because I'm thinking, well, if interest rates do come down, that's good for bonds, but it also means that what's the next step after bonds? So like 12 months from now, what am I thinking about? It's probably something like CRED. So that makes a lot of sense. Tom, this is always a good bit of fun to chat. So thanks for having me in the Betashares HQ. It's good to be here.
Yeah, no worries on. Always a pleasure, mate.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.